Warren Buffett calls them the three most important words in all of investing. They're the bedrock of his entire philosophy. And his mentor, the legendary Benjamin Graham, believed this one concept is what separates truly intelligent investors from, well, everyone else. So what are these three little words? Margin of safety. Let's break down exactly what that means and, more importantly, how you can actually use it.
Now, to really get this, we're not going to start with the stock market. Nope. We're going to start with something much more solid. A bridge. Trust me, it's this powerful and super simple analogy that makes the whole idea just click into place.
Okay, so think about it for a second. When an engineer designs a bridge, they figure out the absolute maximum weight it could ever possibly have to hold, right? And then what do? They build it to handle 5, maybe even 10 times that load. That extra strength, that buffer, that's its margin of safety. It's the built-in room for error, for bad luck, for the unexpected.
And here's the genius part. Benjamin Graham looked at that engineering principle and had this brilliant flash of insight. What if you could apply that exact same logic to your investments? He did just that, and his most famous student, Warren Buffett, took that one single idea and used it to build a multi-billion-dollar empire.
All right, so let's jump from the physical world of steel and concrete to the financial world. How does a margin of safety work when we're talking about stocks and money? Well, it all comes down to a really simple but absolutely critical gap.
Here it is, the core definition. A margin of safety is simply the difference between what a business is actually worth, its real, underlying intrinsic value, and the price the market is asking you to pay for it at that moment. That's it. It's the discount you get for buying.
And this chart just makes it crystal clear. Let's say you've done your homework. You've analyzed a company inside and out, its profits, its assets, its future, and you calculate that its real value is about $100 a share. But you look at the market, and right now, maybe people are panicking, and they're selling that same share for only $60. Well, that huge $40 gap, that is your margin of safety.
So in our example, the math is easy. A business worth $100 that you buy for $60 gives you a 40% margin of safety. And you have to understand, this isn't just a number. It's your protection. It's your financial shock absorber. It's your cushion against all the chaos of the future.
So here's the crucial question, right? What is this protection actually for? Why is this gap so incredibly important? What kind of real-world problems does it solve for you as an investor?
Well, it protects you from three main dangers. First, and this is huge, it protects you from yourself. Because let's be real, your estimate of what that company is worth, you might be wrong. Second, it protects you if the company itself hits a rough patch, a new competitor, a bad product launch. And third, it protects you when the whole economy just decides to take a nosedive. This gap is basically built-in forgiveness that can absorb a ton of mistakes and just plain bad luck without wrecking your investment.
Okay, so if this idea is so simple and so powerful, why doesn't everybody use it? Why do so many investors get this completely backwards and end up buying high and selling low? Well, the answer has almost nothing to do with math and everything to do with psychology.
Graham absolutely nailed it decades ago with this quote: "The biggest risk you face in investing isn't a bad market. It's the person you see in the mirror every morning. Our own emotions, our greed when things are going up and our fear when they're going down, are what cause the most damage."
Just look at this breakdown. It feels so psychologically backwards, but this is the entire key. The emotional crowd feels safe buying when prices are already high and everyone's excited. That's when the margin of safety is smallest or even gone. But the disciplined investor, they know that real safety comes from the price you pay. They buy when things look cheap, even if it feels terrifying. They've basically trained themselves to go against their own gut feelings.
So the big question is, how do you actually do that? How do you become that disciplined investor? Thankfully, Graham didn't just give us a cool philosophy. He gave us an actual, actionable 3-step framework to follow.
So here's the framework. It's simple to understand, but it takes real discipline to execute. Step 1, you gotta do the work. Estimate what a business is actually worth. And this isn't just a wild guess. It's about digging into the numbers, the assets, the earnings, the cash flow. Step 2, you only pull the trigger when the market offers you a price that is way below that value. And step 3, probably the hardest of all, you have to have the patience to just sit there and do nothing until that opportunity shows up. And Graham gave us a real-world benchmark here. What does significant discount even mean? Well, for him, it was usually at least 33%. He wanted to buy $1 worth of a business for no more than 67 cents. And if the business was a little riskier, he'd demand an even bigger discount. To help with that tricky patience part, Graham invented this amazing character he called Mr. Market. Just imagine the stock market is your business partner. And every single day, this guy shows up at your door. Some days he's euphoric and happy, other days he's depressed and panicked. And every day he offers to either buy your shares or sell you his. Most days his prices are just nuts, but every once in a while, in a total fit of despair, he'll offer you an incredible bargain. The intelligent investor just ignores all his mood swings and patiently waits for the bargain prices. So as we start to wrap this up, the entire philosophy really just boils down to a very simple relationship between three things: price, value, and the protection you get when you understand the difference between the two.
This famous quote says it all, doesn't it? Price is just that number blinking on a screen. It bounces around all day based on fear and greed. But value? Value is what the underlying business is actually worth. A smart investor never ever confuses the two.
And that's the bottom line. That's the whole game. The bigger the gap you demand between the value you're getting and the price you're paying, the more protection you have. That gap is your margin of safety.
So in the end, this whole concept just completely reframes the question most people are asking. It's not about timing the market or guessing what the economy will do next. The only question that truly matters, the one you should be asking yourself, is this: does the price I'm being offered today give me a big enough discount, a sufficient margin of safety from what I calculate this business is truly worth? Answering that one question correctly, well, that's the secret to a lifetime of successful investing.